Good morning, everybody, and so glad to be with you. It's always a lot of fun on these Trade Thirsty events to share things that I've learned across nearly 3 decades of option trading. We're going to talk about how to leverage the FANG stocks. That's Facebook, Amazon, Netflix, and Google. We throw Apple into that mix using weekly options. So basically, we're gonna really keep it very focused on a simple strategy. We're going to show you a lot of charts. I'm not going to give you a big sales pitch. It's basically, I think you'll see just how effective it is as you go through tons of examples today. Before I get into it, just a reminder that everything I'm sharing with you today is for your information and education only. The information here that I share does not constitute a recommendation of buy or sell any particular investment. And you know that you are solely responsible for your own investment decisions. Big Trends and the staff are not responsible for any trades you choose to make. At Big Trends, we really seek to empower you so you can make better trading decisions whatever time frame you trade. But not all Big Trends products and services are appropriate for all investors, so keep your risk level in mind. I'll share with you how I manage risk on these FANG names, and then we don't provide any personalized financial, tax, or legal advice to any individual. What I do is we send out all of our Big Trends research on our FANG names via real-time emails to our entire FANG option trader list and real-time text alerts to your smartphone. Make sure you're aware of your tax situation and consult a tax advisor. How trading might affect that with the tax law changes, definitely something you want to be keeping in mind. So what we're going to focus on is what are FANG stocks, and I think most of you know that, but we'll go into a little more detail. But key benefits of why weekly options make a lot of sense, especially when we talk about weeklies on higher dollar stocks. All these FANG names, as you know, are pretty much in the stratosphere. I mean, you think that they've gone too far, but yet they've been the main driver of this bull market, especially in the last couple of years. When you see Amazon doubling year over year, Netflix, even with its last earnings report being down, it still has had a huge last 12 months. There's just so much opportunity here. And what I want to focus you on, instead of looking at a jillion different things, is one simple indicator, one simple setup that we use, that you can use as well at home to define a trending stock on whatever time frame you use. I'm going to show you the very specific kind of quick trades that we like to do, usually over 2 or 3 days. Sometimes in a day, but bottom line is definitely kind of a quick swing trade approach with loads of case studies. I'm a big believer that whatever you do in life, you've got to model success. Model success in your trades, model success when you see other people who've been successful. You model that, you're going to be following in those same footsteps. So what we're looking at here, of course, the FANG names, the traditional ones, you're looking at think of the F for Facebook, the A for Amazon, the N for Netflix, and the G for Google. But we throw a bonus in there with Apple. So we could call it FANG, but bottom line is that, it's just one of those those are 5 big names, and they're big not just because they're, tech oriented, but they're also kind of disruptors, if you will. Netflix has binge-worthy content. Amazon now controls a massive amount, like something like almost half of all, no, it's a third of all online sales and like 5% of all U.S. retail spend. I mean, just insane kind of volume that Amazon has been able to drive. Facebook, of course, with social media, got pounded last week on the earnings. We stayed away from it to not have that kind of gap risk. Google, of course, with the paid search. Apple, dominating with the mobile smartphone market and their ecosystem. So why should you care about this method? Well, this shows you that over almost 2 years, 23 months, you took a $10,000 portfolio and put $1,000 per trade in. So we never commit more than 10% of our capital into any trade, that you'd be up $6,500 over 23 months. So, it's one of those that, you see it's not straight up. There's going to be occasional months that have a little give back. But all we're doing here is we're buying options. We're buying a call when we're bullish. We're buying a put when we're bearish. And so when we break it down on a month-by-month basis, you can get some flavor. This is gross profits, so it includes all of our profits before you take a commission. So make sure that your commissions are not too high. If they are, you can get more details. Chris Sarah, my lead consultant's in with us as well to help answer questions. He can tell you more about options brokers we like, who can also help you get in and out automatically in this program at no additional cost to you. So just what you'd normally pay through that broker, they just do the work for you. So you can see that, we've had, a lot of good runs, including some monster months like January up 2,600, March up 1,600. Then had a little give back you can see the second quarter, and then this is just through earlier this past week. we can see up 795 in July. So that's, if you're assuming on a $10,000 portfolio with no compounding, you can start assess about what kind of percentage return you might be able to make on that money a month. And typically, in that several percent range, 3 to 5% per month, we think is sensible. So if you're shooting for 10% a month, sure, there's months like that, but sometimes if you get too aggressive, it can get you in trouble. If you just looked at the 2018 results, they're even better over, you can see we haven't quite got to 7 months yet with 3,725 gross profit dollars. This includes all winners and losers before commission, and says, you know what, okay, so break that down, even divide that by 7, and you're in the neighborhood still of about, $550, $540 a month. So from that perspective, it's be a 5% a month type of a return if we can keep that going, knowing that some months are up, some months are down. So you have to stick with it through the up and down cycles. And so a big part of what we will teach you here is how to get out quickly if it's not working. I'm not just going to show you when it is working. I'm going to show you examples like when it doesn't work, where we would hop out as well. So here's a pretty recent example here from just a couple weeks ago on Google. Parent company's name is now Alphabet, but you don't alphabet something when you search for it, you can still Google it. But here's a case where, because Google has gotten so high and we're getting our signal, it's happening at the close of this bar. We're at about 1185. If you bought 100 shares of Google stock, that would cost you over 118 grand. We're able to buy one call, and we used to cap them out at 10. Now we cap them out at 15 because of how high Google and Amazon have gone. So that means if you buy one contract at 14.43 was our average entry price from our options auto trading brokers who help get our subscribers in and out automatically on every trade. That means you invest $1,443. That sounds like a lot in a trade, especially if you're new to options, but that's basically just barely over 1% of what it would cost you to buy the stock. So that's where your leverage comes in, because you get a 2% move in the stock. In this case, even a 1% move in the stock leads to a 49.7% gain the next day. So went from 1185 to 1200. That's like 15 points. Call 1.5%. We're in the 35 or 40%, 40 times leverage range. And what is the setup here that we're going to talk about? This green line here is what I want you to focus on throughout the presentation as our main driving factor. This is called ADX. I'll tell you more about ADX in a minute. ADX here, wanted to get into some charts right away and not just spend a lot of time on text slides. What we're looking for is that ADX to be low in green, below the 2 DMI lines. The positive DMI is in blue here, the negative DMI is in red. You see it got below both right before we got this upturn, and as it starts to turn up here, you can see here, I'll put an arrow on that and draw the arrow up to, it's that bar right there. At the close of that bar, it's saying now it should be moving into a trending mode. I'll explain more about ADX in a minute, but you can see, compare that to when ADX is headed down, look what happens to the market, or in this case to Google shares. They're essentially going nowhere. You see, you get a lot of volatility, but not a lot of direction. Now, if you buy options through that period when it's just chopping around, you think you can buy the low and sell the high of a defined trading range. My experience with that is that you're going to lose money over time trying to buy options off the support, hope that it bounces to resistance. Because either A, it doesn't bounce, or B, it takes too long and you end up having a lot of time erosion and time loss in your options. What we need when we trade, especially buy options, is we need speed of movement. We need clear, consistent trends with very little give back so that you can have that fortitude internally as well as financial fortitude to stay with that trend. Now, what we do is we will wait and we'll get out of this one when the ADX rolls over. It had a slight rollover in green over here at the end of this chart. So we're hopping out at like 1195. So you can see it's up less than 1% at that point, up about 10 points, and that's 49.7%. We'll show you a ton more examples here. But I'm kind of curious, too, to get some flavor here as to what kind of a crowd we have with us. Type in one of these numbers, 1 through 5. Are you a day trader, basically 1 or maybe 1.5 days? Type in the number 1. Swing trader, 3 to 5 days. Position trader, 1 to 4 weeks. Just kind of curious what kind of crowd with us. We got some day traders right off the bat, and then we got some that are saying they're a combination, 1 and 2 on several, 1, 2, and 3. We got some 2s, we got some 3s. So really a mix between these 3 categories, which is good. Where I'm focusing you on here is somewhere between 1 and 2, probably call it 1.5. We're in that 2 to 3 day window usually, but sometimes it can be in and out in the same day. It's very rare we would hold something more than 5 days in this particular portfolio, because with the FANG names, you either need to hit it quick or you need to hop out. And so the idea here is, and thanks for your feedback, it's got a nice mix of mostly swing and position traders and a decent, more than I expected, day traders. But the idea that I'm going to show you here as we go through these chart examples is that you can do this if I'm using 30-minute charts, and I'm talking about a 2 or 3 day hold. If you're swing trading 3 to 5 days, you should probably just convert on up to about an hourly chart, about a 60-minute chart. If you're position trading 1 to 4 weeks, take the lesson that I teach you here on the ADX pattern and use it on a daily chart. Active investors, 1 to 12 months, use it on a weekly chart. So there's a little bit of something for everybody in there. Okay, now when we talk about our trade funnel, it's that, I love that saw graphic because it reminds me of Stephen Covey and all of his great lessons. But one of his was sharpen the saw. Goes up to somebody who's saying, hey, somebody's sawing furiously on a tree, it's going nowhere. He said, you make a lot more progress with a sharper saw. And the guy turns around and says, I'm too busy cutting this tree, don't bother me, right? Well, sometimes we're like that as traders. We want to just dive into the action without maybe the best or sharpest tool set. And so, I've spent, since when I graduated from Duke University, I jumped right into the trading game in 1990. And basically, so I've spent almost 3 decades here, really cutting my teeth and sharpening my saw on what I think are the best tools for different type pockets of opportunity. And this pocket of opportunity, ADX, is what we really find works really, really well. So you don't have to, kind of have a whole bevy of things at your disposal, but I'll show you the building blocks of what makes up ADX. This makes a trade funnel where you can kind of filter out the noise and really get focused on what the better opportunity is. What you're going to find with a lot of these is that you're never going to catch the exact low. I was once at a Charter Market Technicians, CMT Market Technicians Association conference where John Bollinger was giving a talk, and he said that his mentor told him that he was only allowed to call the bottom tick exactly and call the top tick in exactly once in his trading lifetime. He said, yeah, that doesn't sound like a very good pursuit. The idea is that we're trying to get in, I agree with him, we're on the sweet spot here looking for where the momentum is picking up. So you see Amazon's really slow here, and then, of course, you get a big breakout, and you say, well, gee, you feel like you've missed it when it makes that big surge here, and you can see that first big gap up. A lot of times it'll happen right in that first half hour, right at 10 a.m. Eastern. We may well get a decent number of our signals because you're getting some catalyst, some change. Could be, earnings, could be, we won't trade in front of earnings, by the way, but we might trade them after earnings once we get the gap risk behind us. But bottom line is that we want to make sure that we're taking advantage of whatever that new catalyst is. So here's a case where Amazon's 1770-ish and we're buying a 1792.5 call. It's taken us a little bit to kind of start to work up from where I'm usually more conservative in my options strategies for the most part, and actually preferring to buy in the money options when I can. You can't do that and keep your option price under $15 or $1,500 a contract on Amazon. Obviously, 100 shares would cost you now approaching 880 grand, right? We're controlling this, in this case, 177 grand worth of stock for just under $1,500. That's less than 1% of the cost of the stock. So you can see in this case, we did take the profits the same day because we do put in place some trailing stop rules, which I'll tell you more about here. Essentially, what we want to do is once we get up over 30% in the option, then we're going to start trailing our stop. We'll move it up to break even at that point, and then as it goes up to, say, 50%, we'll typically move it up to about a 20% trailing stop on the positive. If it goes up to, 80%, we might move it up to a 50% trailing stop. So we'll give it some room. You can see on this bar here where it kind of reversed down. Even though the ADX was still going up in the green line here, from our initial entry point when the ADX first got going and crossed up right here at the start, you can see that ADX just keeps cruising up, and so does Amazon. But bottom line is that if we're giving up too much price action, we don't want to let those profits slip away. Let's talk real quickly about directional movement in ADX. Wells Wilder, the same guy who also invented the RSI indicator, I know a lot of you are familiar with, decades ago. He made an interesting observation, which he said is that he made a lot of interesting observations, but in this case, he said the true range should include if there was a gap from the prior day's close. A lot of times people just look at the high-low range and say, well, the high-low range might be tight, but if we had a big gap up, that he would say, well, that true range has to include from the prior day's close, you've got a lot of net positive directional movement. So he's really picking that up, including gaps, and then he would create an average true range to show how much total movement you're getting within a trend, a look back period. DMI lines, the directional movement lines, show you, are you making net new highs over the look back period? If you're looking over the last 20 days, are you making a lot more new highs than you are new lows? And if you're making higher highs and higher lows, as you know, that's the definition of what? An uptrend, right? So when what you see with the ADX is that it starts to actually show you that, look, if the DMI plus, you're making more new highs and then you're making no new lows, so the DMI minus is going down, guess what ADX is going to do? ADX is going to start going up because you're going to see that the gap between those DMI lines is widening and showing you that you're getting into more of a trending phase. If you're in a chop city kind of a phase where you're just kind of going back and forth on the DMI lines, ADX is going down or staying flat, that's telling you that you have no clear trend direction. And then Wilder said, okay, then divide it by the stock price and give it a percentage from 0 to 100% here, and we'll figure that out. Now, and I've got some older examples with a black background, but we've got a lot of feedback that the white background's a lot better, so we've been converting that. But bottom line is that you can see there's just a lot of times on these charts where if you see something that's down, down, down on the ADX on the green line here, you don't want to try to trade that. You can just see how many times that will actually save your bacon. So you've got the trading capital and your trading confidence hasn't been chopped up. So you got to manage not only your financial capital, you got to manage your psychological capital as a trader. So you don't want to overtrade. You don't want to trade just for activity's sake. You'll say, look, when this pattern sets up here and starts breaking out there, now it's in the neighborhood of about 1140 here. We're buying 1142.5 call at $962 that we're controlling a stock worth, 114 grand. So you can see in this case that steady move up, and you see our trailing stop's going to get triggered. So we might have also gotten a little bend down in it at that same point on the ADX. So we would get out if the ADX bends down just for one bar, we're out. Or if the trailing stop hits its kind of profit protection level. So, this was probably up about 150%. We got out 121% the next trading day. So in on a Friday, actually out on a Monday. So, sometimes you might hold something like that over the weekend. That's fine. A lot of people would say, well, hold on. At the beginning of this chart, look, you were right up into all of this overhead resistance. Why would you buy right into that overhead resistance when we're getting our new buy signal here on this up arrow? Well, because, the structure of this price action is changing. A lot of people don't realize it yet, but that gives you an early opportunity signal to start to really accumulate, and before you see this big blast to the upside a few bars later, where a lot of people are then chasing. Google on the downside, here's a case, where we had the 992.5 puts as Google, again, was trading a little above 1,000, about 1,020, and we said, okay, we're buying the 992.5 puts at 1480. I think this one might have had earnings coming up, so we knew we had to be in and out before the earnings. But sometimes when earnings are coming up, you're going to end up paying a little more for that option. That'll lower your profit potential, but it'll also lower your risk as the volatility stays juiced. But don't hold that thing into earnings, because then the volatilities get absolutely imploded and collapse. So we want to say, look, we're in this one afternoon, we're out the next morning. As it comes down, starts to come back up, we're hopping out somewhere in this neighborhood here as it hit about probably an 80 or 90% gain for us, and then we got out at a 60.8% gain. So one of the things you have to learn as a trader, it took me a little while, kind of with my educational background, with the mentality to get great grades and beat everybody else, and it made me be very much of a perfectionist when I got into trading at first. I expected to buy the lows and sell the highs. I expected to be perfect in my entry and exit points, and the reality is we just need to catch the sweet spot with options. You need to let go of that perfectionism, because if you have perfectionism in trading, once you start having a loss, what will a perfectionist not be able to do? Will not be able to get rid of a losing trade. So, if we get into this thing and immediately flips back up and the ADX turns down, we got to hop right back out and take a small loss and move on. That happens, with some regularity, because the reality is not every trade is going to fire. When it doesn't, we get out really quickly on our losing trades. So, from this perspective, again, the idea of options, if you're new to options, I know I saw some people earlier that said they were new to it, is that why would I buy the stock when it's cheaper to lease that stock or rent that stock with an option? So I know I'm not going to be in these trades more than 5 sessions. So if I buy, say, the weekly options that expire, say, the following Friday, I'm going to get options that will have typically anywhere from 1 to 2 weeks until they expire. So that way I don't have to worry about that kind of risk of riding it right up into an expiration. I can get that leverage without having to go spend all that extra capital to buy the stock. Now I prefer, like on a Facebook or an Apple, I'd like to prefer to buy in the money options, because then I know those stocks, Facebook, got really popped down there yesterday, and bottom line is, like I said, it was in the 200s. Now it's back in the high 100s. But bottom line is that you can buy typically about 5 points in the money on those, and actually create kind of a stock substitute. So you get the benefits of kind of a stock ownership without having to pay a lot of extra time. Just say Google's up even more than this, and so we're getting leverage potential now anywhere between 70 to almost 100 to 1 for the type of Google options that we would buy. And this is where your leverage comes in, because you're putting in oftentimes 1 or maybe 2% of the cost of the stock with these options. Here's one you're putting a little bit more on Netflix. This is Netflix breaking out. And by the way, I didn't mention earlier, we do add a moving average filter. This black line here is a moving average, and you get all of our settings in our FANG Options Trader rule sheet when you become a subscriber. It's positive, which means that if we had a negative setup, almost looks like we had a negative setup here, not quite on the left side of the chart, where it looks like ADX starts turning up from a low level with the negative above the positive, but you're above the moving average. There's no way we'd take that trade. Even though it kind of ground a little bit lower, that's just too slow for our bang for our buck. So in this case, we said we wait till Netflix starts to go to the upside with the positive filtering. And you see, as this thing starts turning back up here, we're getting the buy signal right here into that close of that bar. And sometimes you get that buy signal and then it just chops around for a couple of bars. This is, again, a 30-minute chart on all these examples. So the idea here is that, look, if we're getting a buy signal that's just flattening out, ADX is really stable at kind of keeping you in and not getting you whipsawed. I know a lot of traders will say, oh, I don't trade indicators, I just trade price action. And I say to those traders, here, let me hand you a neck brace so you can handle all the whiplash you're going to get just following price action on a bar-by-bar basis. And the shorter term you go, the more you need that neck brace. We don't want that. We want to say, look, let's focus here on how it can be stable. And notice, even as we're flat for a couple of bars, it's still heading up. Why is that happening? Because you're losing older data that's lower than where we are now at a higher level here. And so the reality is that you don't have to worry so much about chop or noise, although if it's enough of a reversal, the ADX will turn down and it'll tell you we got to hop out. Technically, you say, well, gee, where did ADX hop out here? It hopped out a few bars later here on this little gap down right there. So if you were just following the ADX turn, that would be your exit. But our profit protection stop said get out the day before, when it ran up and started to roll back down on this particular candle right here. Notice it turns out it's about the same level that it would have gotten you out the next morning, but you didn't have that next day's gap risk. And yes, we could have said we sold it a little early, but at the same time, we have learned that, if the price action is not stable, if it's getting a little more volatile, that's something you want to be careful that obviously ADX is going to follow price action eventually if that price starts reversing too much against you. Another Amazon example, what I love about these is when you see you get in here into the close here on this bar on Amazon. That was a Monday morning, a couple bars into the trading day, about an hour and a half into the trading day. And then you see sometimes it just flattens out on you. So another case where you say, gee, if you're buying out of the money Amazon calls, this one had earnings as well because it was in the low 1300s. We're buying a 14.15 call a couple weeks out. You say, gee, that sounds like unlikely to get to its even strike price, right? How am I going to make money on that? Because this thing moves so fast. The next day it's up to 1340. It's gone up about maybe 2.5%, and that option's up 64.8%. So the principle here is that if it's flat like that, what I want to see is that ADX keeps grinding higher, and you see it does here. So in this case, that's the kind of thing that will really help you. Again, it got a little too volatile in that next gap up and then started to come back down intrabar, and that's what hit our profit protection rule. Facebook, another example here, right at the start of the year. This is the start of 2018. And so you can see here that Facebook had been a little negative. You can see it was below our trailing moving average here in red, and then it starts getting above it here right as we kick off the new year. As you know, January, the first 3.5 weeks of January were very good, and We definitely had our best month in our almost couple-year history on the FANG Options Trader program in January, and then managed to hold on to it pretty well in February, and then had another good month in March. So hang in there sometimes when it's not doing its thing. But bottom line is, you can see the breakout happening here. It's happening as this ADX crosses. Again, this is a 30-minute chart, so set this up at home, and you can actually you can play around with your settings or whatnot. But once you become a subscriber, you can use the same settings we give you on a 30-minute for an hourly or a daily, or even a longer time frame if you're a longer term investor. So you can use this for a lot of different approaches. But our philosophy is, look, when the stock's trading here about, you can see maybe 180 and a half, we were buying the January 175 calls. And those intrinsically, if you're new to options, that means you have a right to buy Facebook shares at 175. It's at 180 and a half. It's already worth that 5.5 point difference. Why do we pay then the extra, in this case, almost buck of time, 85 cents more time? 15% of the total premium is time risk, because that's what you have to do when you buy options. You're buying some time component. But by buying them in the money where you can dramatically turn this into a stock-like position with an 85% delta. Let's say that means the stock moves up a point, your option is going to move up 85% of that point, 85 cents on the dollar. The money is made because you're paying so much less. You're paying 635, not 180, right? So that's where you see 57.6% 2 days later. This is a case where it was so steady, it never hit our profit protection stop, and then it rolled over. Now, a lot of people also ask me, when ADX rolls over, should I bet the other direction and now bet on the downside? And the answer, as you can see, is absolutely not. Don't make that mistake. The DMI lines are still net positive for a few more days, but also you can see that it gets more uncertain. A lot of times these things can keep going, but at that point you see the ADX turning up right in here. Would you take that trade? No, because you can see it's at too high of an ADX level. It's not coming from a low enough level. So while it does catch that brief run up, then it rolls over, and basically you're dealing with a higher risk trade. Obviously, if you hold and you go, hey, I'm making more money than where Headley got out, you're feeling pretty good, and then bam, you wake up next morning after feeling pretty good there, and you say, uh-oh, I'm in trouble here. It goes from 188 to 178 on the open, down 10 points. That's as that news is starting to break about their data issues, and eventually their CEO, Mark Zuckerberg, testified in front of Congress for it. Bottom line is that this is the kind of thing that you really want to make sure that you just catch that sweet spot, and when the indicator is no longer active, you get out and move on. What that does inside of you is it instills a ton of confidence. I talked to a ton of traders who tell me that the biggest thing they're trying to work on is getting a lot more confidence and consistency in their trading approach. And consistency doesn't mean that you have to win 98% of the time. I see a lot of emails out there of, oh, we've had no losers and yada, yada, yada. And I'm like, I'll believe it when I see it. But the bottom line is that, my experience is that if you can just be consistent to your approach, you can take small losses and bigger gains, and that's really the secret to trend trading success. Now, we do this every single week. There's weekly options, and with these big FANG names, they already have their multiple weeks out weeklies listed for every single Friday expiration, usually 4 to 6 weeks out. And they used to be that they started on a Friday to end the next Friday, and then they expanded it to start on a Thursday and the next Friday. But all the FANG names have weeklies going out already for a month plus. This can allow you to take advantage of the reaction after we get a big catalyst like an earnings report or something like that. But the bottom line is that, even with the gap down in Facebook yesterday morning, it didn't actually set up as a bear trade because it didn't follow through. It got the gap down, and then it just kind of chopped around and didn't give us the downside follow through that would have suggested that it could actually make you money on the downside after the gap. So we say after the gap, why not take advantage before the gap? Because you pay too much for those options in front of that. Every once in a while you get a big move like Facebook, but too many of the times, like you get a move like Amazon had yesterday where it had doubled the expectations on earnings. It crushed them, and even the revenue was a little soft, and that ended up being a very slight positive move, which would have killed you if you bought calls or puts in Amazon before that news. So we wait for what we think is a lot cleaner period to trade after we get the earnings reaction, or well enough in front of it that we don't have to worry about that gap risk. So you see, here's a case with Apple where the second bar in, we're getting that upturn in the ADX. Again, here's an example where the stock's trading in the neighborhood here, you can see, of about 160. And here's a case where we're buying a little bit more time than we usually would. We're buying a 155 call. It's 5 points intrinsically. We're paying 7 for it. So you can see in this case, maybe they had earnings coming out at the start of November. I think they did in that example. But, bottom line is that you're looking at that and saying, okay, well, we want to catch that sweet spot. And you can see in this case, that nice steady action, even though it flattens out a little bit in that first day's close, ADX keeps going up in the green line there. So as long as it doesn't hit our profit protection stop, flat is fine. That little flag pattern, even this flag pattern, you can see was okay for initially, but the longer it lasts, eventually it's going to catch up, and you see ADX kind of went down just a hair, not much, but we're picky. Even a little turn down, we get out. So, it's catching that sweet spot the next day, 73% and change. Another Apple example, this was our Cinco de Mayo trade in right at the start of May 5th. You can see here that as it gives us that kickoff in Apple, that there's that initial pop up. And again, you're going to see, you look back and you say, man, this thing's been dead money. Why would I want to trade it? Because now it's coming out of that dead money phase and saying, okay, you need to be a part of this on the upside. And you can see, again, nice initial burst, then a little flag, and ADX keeps on rising. Some people say, well, should I get out here when the positive DMI crosses underneath the ADX? Isn't that going to eventually pull the ADX down? It's possible that it could. You can see in a lot of these cases, you'll note that it got some more opportunity before it rolled over. In this case, the next day it was a little higher by the time it got us our 102% gain 3 days later. We don't put a fixed target on here at 100%. We say, look, keep riding. Some of these can go even bigger, and you give yourself a chance to really take advantage of that. So, let me talk a little bit about options theory for a second and say, you know what? A lot of people don't understand that sometimes it's a lot better trading the high dollar stock options than it is the low dollar stock options. Let's assume the same percentage move. Each stock's going to go up 5% in 5 trading days. And so we're looking and say, out there, say, we got 2 weeks before expiration, you're going to hold it for a week. And this $20 stock's going to go to 21. We'll put that on the left. The $210 stock's going to go to 210. So just a multiplier 10 on the stocks here, okay? Now, in both of them, we're going to say we're going to go 2.5% of the money. We're going to buy a 19.5 call on the $20 stock. We're going to buy a 195 call on the $200 stock. You run them through an options price. You might say, what would you pay going out a couple of weeks for similar volatilities? And you see it shows on the $200 stock, we pay $5.50. On the $20 stock, we pay $1. So it's saying, you know what? Okay, when we pay $1, that means half of our option is intrinsic value, 19.5 to 20. Then the other is extrinsic or time value. So that's a half and half situation with a 65 delta there. And on the other side, you see if we pay $5.50 and it's worth $5 intrinsically, that's a much higher delta. We're only paying about 10% of the total premium is time risk, 90% intrinsic. If you $5.50, you could get 2 contracts for $1,100 on the right. You can see thus if we match up $1,100 with 11 contracts for the $1 a piece on the left on the green example, you see you get a move to 21. That 19.5 call is worth a 50% gain, $550 in gross profit. You compare that to what's the 210 call worth? I mean, what's a 195 call worth now at 210? It's got to be worth 15, right? You got 2 of those contracts. That's worth $3,000. You paid 1,100. That means you made 1,900 or 173%. So we're talking about a multiplier here of like 3.5 to 1, so more than 3 times, less than 4 in the potential leverage. The downside of this is that it cuts both ways. So you do have to make sure that you're correct in following something that's working, and if it's not working, you got to get out quickly because options. So leverage is a double-edged sword. With options, you can make money faster, you can lose money faster. So a big secret of our success is when it's not working, we just get out faster. And I think that's really important. So like here's an Amazon example where we're in the Amazon 975 calls right after the gap. You see it gaps up, and the next bar in it signals. Stock's trading about 972. It's back when it was below 1,000. Almost a year ago. You can see it was about half of current levels, and you can see that 865. That nice steady run. Same day we're out for 50% gain. Now, in this case, you see that ADX didn't roll over, but we were maybe a little more concerned about, that we might get some kind of a big gap the next day. It turned out that it did have a gap down, you can see, and then it came back up. So we probably would have been stopped out intrabar on that quick shot down based on our trailing stop rules. So 50% profit was a good idea. Sure, it would have made more if you just could close your eyes a little bit intrabar there and just stick with it up to 990 instead of our exit in the 981 range. But, bottom line is we're always cognizant and thinking about risk as well as reward, so we make sure that we don't have to be heroes here. You can see in this case, here's an interesting example because Netflix gives this big surge. It just gets above the moving average on the big surge on the ADX upturn there. And so you say, gee, you're in, and it looks like, oh, you're wrong because it's going down here. But interestingly enough, because we were able to buy, in this case, an in-the-money call, is a 182.5 call when the stock was trading about 186. You can see here that, okay, it's worth about $4.25 intrinsic, and we're paying $5.91 for it. Might have been an earnings report that was due out too, because it was paying a little more than we would usually probably pay. But that gives you that kind of cushion to say, you know what, volatility can stay high. This thing settles down, then it takes off the next day. That big launch the next day was beautiful. So, and then that give back there at that point was giving back too much from that little peak a few bars before. Yes, it too also went a little higher by the time the ADX rolled over on the pure system basis. But we're really picky about not wanting to give back profits within a certain range. You can't be hair trigger about it. You can't put it just 5 cents under a recent high. But you can say, you know what, you can give it a little bit of wiggle room, but not too much. Another example with Facebook. This was back when it was a lot lower in the 127.5 level. We were buying a 124 call worth about 3.5. We paid only $3.90 for it. I love those kind of situations where you could get about 90% intrinsic, about 10% time, and you can see it doesn't take a huge move by the time it rolls over on the ADX versus our entry that was, of course, a couple bars in. You can see that when it's rolling over, stock's now 130 from 127.5. It's only moved up 2.5 points, barely over 2%. It's up 74% on the option the next day. So your leverage can be tremendous even when you're buying the more conservative in the money option. You don't have to be a go-go gunslinger. You can really focus yourself on really the best of the best type of opportunities here. Now, risk management I think is really important for us in terms of if it's not working, we're going to tell you to hop out very quickly. So there will be some day trades because when we get in, it doesn't fire, we get back out. We're very sensitive to that, so we never will send out more than 3 day trades over a 5 consecutive day span if we've had day trades. We don't try to have them, but the bottom line is that sometimes you just have to be prepared for that. So the idea here is that, okay, when you see Google starting to really hum here, you see it just starting to launch, you see, okay, they're just, it's another one of those examples where it's right up into that resistance, but the structure has changed. See, the ADX is now going up, up, up. And so now, of course, only when it starts to roll over enough, this next day gets that slight turn down, then you say bye-bye to it, up 121%. A lot of people think that you should just trade high volatility situations, but I believe that you should actually focus more on high trend situations. Your best trends are going to make you the most money buying options. You could do credit spreads and other kinds of options spread strategies with this, but our experience is you don't want to lose those big outliers, and that's where you'll not be able to take advantage of that if you do spread trades compared to just being a straight directional trader. Also, when you trade high volatility, you pay up for high volatility. So our solutions around that are to get more in the money wherever you can, or if we're going to trade those Amazons and Googles as we are, then we've got to be even tighter on our risk management so we make sure that if it's just flatlining, we don't get hung in something that's too slow. Here's a case where we got a signal on Google right into the last half hour. So a lot of people worry they're going to miss these signals and they're not going to be able to take advantage of that big up move the next morning. By the time the next morning hits, it's already gapping up. This is where you might want to look into auto trading because there are brokers who can get you in and out automatically. Chris Sarah, my lead consultant, can get you more information on that and how to really take advantage of that. Also, you see Google, sometimes it'll be a slower, smaller move. So like here's a case with Google where it just broken under our moving average filter. Now you're getting the negative directional movement going. That means new lows are kicking in and you're not making any new highs. The definition, as you know, of a downtrend, right? So that's going to be a classic kind of an ADX pattern. And then by the time it rolls over, we're going to hop out here, in this case, on the same day, up 33+%. So, a big part of this is that you focus yourself on where you have an edge. If you don't have an edge, don't trade. Okay, so you look at another example here, like here's an example where we could have had a trade on a couple of these and they didn't fire. So let's talk about that for a second. So what if you had a trade here and you say, okay, it looks like it should fire, It starts to go, and then you see it rolls over. Well, then you should be out. Even if it's a few bars later, you can see there's a couple of examples here where we could have said, you know what, we've got this, and then look, that popped back down. Even though it's still at the moving average, the ADX rolls over. Those are going to be quick, small losses. So you might, in some of those cases, lose between 10 and 20%. A lot of them are single-digit percentage losses. But basically, you kind of hop in, hop out until you catch that next, what I call runner. So the runners is where you're going to really make your money with this approach. You don't want to cut your profits short. A lot of people are like, oh, well, anytime I get a 30% profit in this market, I just take it. Mistake, because then you might leave 100% winner on the table. In addition, we can see here what we do is we call out specific real-time trades to you. We say buy to open, that's BTO, and this is an older one here, so you won't make a trade on it. Amazon, this is when it just was crossing 1,000, the June week 2, 1,005 calls. We give you the symbol at a maximum price. In this case, it was 9 or better. We got filled better than that. And then you see, okay, well, gee, you look back. In this case, there's a March example. This is interesting because you saw it gap up, but it looked like you were kind of getting this little triangle pattern here. What's going to happen? Well, you see it crosses the upside. Your ADX is turned up. And another example where you got a little give back into the close, but the ADX flattened out, but it didn't roll over. And that's really important. And then you can see it keeps going the next day. The morning after that was one of our better FANG trades on record, up 168.9%. So, the thought here, and it ended up going a lot higher still, so basically don't make the mistake when ADX rolls over of getting out on those situations, or more importantly, reversing. We want to get out. We don't want to reverse from a bull to a bear that quickly. Take some time for bearish setups to form after you've had a nice bull move. The whole idea here is you got to have a catalyst. Sure, a lot of this is price-driven, momentum-driven, but it can be tied to earnings, it can be tied to product announcements, it can be tied to other fundamental news. Where we can, we want to buy in the money. That higher delta, as we talked about, gives you more of a stock substitute. It gives you a lot more stability. And then the ADX turns will dictate our exits unless our profit protection stop is triggered once we've got a gain over 30%. But ideally, we want to ride until that ADX rolls over. You've seen how many times it kept you in the good little sideways phases, but then it got you out when it started to reverse. And then we don't want to put an upside target because we want to give it that theoretically unlimited upside potential, even though, yes, usually around the double plus, we're starting to get near those potential reversals. And you see, a big thing that I like to do with my subscribers is I give a video trading update every week where you know what I'm thinking about all the FANG names, whether we traded them or not, what our system's saying, and what the next likely outcome is. And whether we had a winning or losing week, we will always update you every week on all of our open positions to know, okay, how are we standing? And then we send you real-time emails to always update you on open positions too, so you're never left hanging. I'm a big believer that you've got to know that you can get out of all these situations. So this is kind of an interesting one on Facebook because you can see as it started to give us this buy signal here, and you can see there's a prior example here that doesn't look like it did much, giving a buy, and then a few bars later rolling down and give you a quick loss. Okay, so if you're wrong, you're going to be wrong small, and you won't be wrong for long. Okay, and if you're right, our goal is to be right for a longer period and keep riding. I think of the old Jesse Livermore quote where he said, "It wasn't my buying or selling that made me the most money, it was my sitting." And I used to always wonder, how can he say sitting? He was a floor trader, active guy, but what he was saying was when he caught a trend, he was good at riding it and giving it a chance. And that's what ADX does for you here. It came close to rolling over right here, but it didn't. And so you get to participate in the good phase. Obviously, I wouldn't have to look at the chart to tell you that I know that's going to be a good phase to the upside with that kind of consistency of ADX. And then when it rolls over, it becomes uncertain. It pulls back and it rallies some more sideways. Your guess is as good as mine in a declining ADX phase. I believe, if you're betting on trading chop and we go into a strong ADX upturn, you're going to have a hard time trading against that trend. So be careful on that. 89.7% gain on that one just a couple days later. So as I said, if you came in late, for the year to date, through earlier this week, up $3,725 in gross profits, adding up all the gains and losses before commissions. Make sure you're not paying too much for commissions. We have brokers that we can refer you to that can help you to get in and out automatically when you become a subscriber to FANG Options Trader. This shows you the month-by-month results, you can see for the last almost 2 years, including the 2018 total return, $3,725, and then $6,500 plus gross profit dollars since you can go back to August before last. So coming up on the 2-year anniversary there. You can see over the 2 years also 6,500, and you can see to get a flavor for the upside and the downside. There's always risk in any options trading approach. I always tell people that what we know is that we could get stopped out quickly on several and then have to basically take a little pause because we don't want to do too many day trades in any 5 consecutive day span. So we would sometimes say if it's getting a few quick stop outs, we might just take a few day break and then come on back and fire away. Part of the secret is knowing when things are really lined up for you. When they're not, it's knowing when to cut and run. And so what we've done for you, try to help Jeanette get back on schedule here, moved it through a little faster than usual. But basically is what we've done is we've set up this really insane, I call it my Christmas in July special for the Trade Thirsty crowd here today. Usually I wouldn't do this until it was the end of the year. This is something we call the BOGO, buy 1 year, get your 2nd year free. I call it an instant double on your subscription time. And usually it's $19.95 a year for the FANG Option Trader Alerts. We're getting about 100 alerts a year. I recently did a special on a year where I cut it from 2 years down, or I cut it from that $19.95 price down to $9.95 for 1 year. But I'm actually doing an extra bonus by taking it from 1 year up to 2 years. You get 24 months access, which means that over the next 2 years, you get at least 200 trades. And so you can see you start getting your cost per trade down into a very minuscule number. So when you can make potentially a double on one of these trades, and if you put $1,000 in, you can easily make $1,000 plus on a really good runner. You can see if you're paying $5 a trade for that effectively on this kind of value, you're going to get an incredible ROI on the investment you make with big trends and the investment ultimately you make in yourself. Because I'm about continuous training, and we give you unlimited email support and, of course, our toll-free 800 big trends number as well. Whenever you've got questions, bottom line is we're here to help. You can get 3 months if that's out of your price range on the $9.95. If that's out of your budget, we essentially 3 months access. Usually it'd be $4.95. You can get it for $2.95 today. I can't do the BOGO on that. Shorter term subscription, but you can try it for 3 months if you want. And then once you see how good it is, you can go ahead and lock in. Even at $19.95 a year, you still be seeing a nice ROI over time. I want to leave a little bit of space as well for a Q&A, but also want to pull up while I'm doing that the special offer page that we set up for you. It's at bigtrends.com/FANG. So when you go to that offer page, I'll go to it real quick here. Let me just do one thing here, pull up a web page for you. Bear with me 1 second. When you go to that page, bigtrends.com/FANG, what you're going to notice here it comes, is that in this page, where did it go? It disappeared on me. bigtrends.com/FANG. There we go. There it is. Okay, with this special offer that you see, we set it up for you. You get the 12 months at half off, and you get the other bonus 12 months on me. So you lock in 2 years for half the price of 1. We give you loads of examples on this order page of how this works, and lots of examples you see on the bottom right of the kind of trade results we've had, that the auto trade exists with these couple of auto trading brokers who can get you in and out automatically. You don't have to lift a finger. You just tell them how much you want to put into each trade. Once you become a subscriber, they confirm with us that you're a paid subscriber before they can get you enabled for that auto trading. We'll average about eight trades a month, sometimes a little bit more, sometimes a little bit less. It just depends on the environment. And then I'll give you the trade videos, and then you can get the continuing education anytime you have questions with me. So all you do to lock in the BOGO special, buy a year, get one, is you add that to your cart. If you want to get the 3 month special, you just click on that text below. That's clickable text. But I'm just going to do the add to cart as the best value here, just to show you real quick what you do. You see, obviously, we assume you'd like 2 years rather than 1 at the same price of $9.95. One-time investment for the next 2 years, and I think you'll see that you'll want to continue it as you go. And then you can go PayPal, or you can just check out here, put all your information in that's in bold to allow your credit card to process. We take all the major credit cards, MasterCard, Visa, Amex, Discover, and then PayPal there if you want to go that route. And then you can say, you saw it on the webinar with me, you can say, if Chris has helped you, my lead consultant, appreciate him taking his time with us here out of his Saturday morning to help answer questions in the chat box. However you want to do that, and then basically say, okay, then also I want to mention this. If you want to get text alerts, you can say text alerts to whatever your cell phone number is, and then so whatever it is, you can just say, okay, that is my number, and then what do you use? AT&T, do you use Verizon, do you use Sprint, you name it. Type in whatever your provider is there in that little message box too. Sprint, no, I can type. Sprint, whatever it is, type that in, because what we do is we set up all of the different providers on separate batch lists, so if ever there's a hang up, there shouldn't be, but basically we just try to make sure that everybody's getting it as instantaneously as possible. When we hit the send button, those emails and texts are firing out, and then all you do is you just review the terms and conditions below, and then click on the submit order button. You'll be good to lock in 2 years for less than basically half the price of one typically. Let me go back though and answer a few questions here, so I'll make sure I cover a little bit of that, and then we'll hand it back to Jeanette in a few minutes. So Chad says, with limit orders, how often do you miss getting filled? Very rarely, because it's got to really run harder against us. We usually give it a little bit of room, even with the limit, because these FANG names are so active and liquid. So that's why I'm glad you asked that, Chaz, is that, since we're, so not just on the stocks are they active and liquid, in their options are active and liquid. So, when you look at how many contracts trade on Apple, on Google, on Facebook, Amazon, and Netflix, you're talking about, that you're oftentimes going to have thousands upon thousands of contracts trading. That's going to keep the bid-ask spreads tight. It's also going to allow us to get in and out very effectively. So, and if we essentially would ever miss one of those, we would then adjust the price if we needed to. G says, can I have a day job and still use the majority of alerts? Absolutely. You can use all the alerts if you use the auto trading feature. So that's the one that we're showing you here. Auto trading is something where you're not paying any more than you would if you were just executing yourself through those platforms on Thinkorswim, now part of TD Ameritrade, also auto shares. And bottom line is that, we had a lot of happy people on both of those programs, and they get the benefit without having to lift a finger. Nancy says, what do you do when the fill price falls rapidly? Do you still take the trade? Essentially, if it goes rapidly against you, then we would typically say you can take that trade until we tell you to get out. If you're getting it after we've sent it and it's gone down from where we recommended it, we still say it's active until we tell you to hop out. Sometimes those snap back up. Sometimes they don't. We get you right back out. As long as you're not afraid to get out quickly when it's not doing what it should be doing, and then know that we won't generate a bunch of day trades if it's getting a couple of quick stop outs. Over the next couple of days, we would then typically take a little breather for a day or two and then start firing away again. So we know that some people trade smaller accounts. We don't want you to ever worry about your account getting into too many day trades. Now, BC says, I don't know options, want to learn what course of mine is the best. I've got loads of educational, we call them boot camps, digital on-demand access. You can just call us at our 800 Big Trends number. BC, tell us you heard about us via TradeThirsty, so we give them the appropriate credit. We always appreciate what TradeThirsty does for us to bring us to all kinds of traders, new and experienced. We can get you details on that. Jignesh says, what period on ADX? You get that as a subscriber. Whether you buy the quarter or the BOGO, buy a year, get the second year on me, you get all the settings from the moving average filters, the ADX levels, the trade management rules. You get all this. Now, how long are you going to have this special? It's not going to last long, because basically I call it my Christmas in July special, but I know there'll be a recording to come out. We'll honor it through the recording day that it comes out. I assume that'll come out the start of the week. But bottom line is that, definitely we should be done here in the next few days. Let's see. Also, got a question from Paulette. Says, can this be used for stocks other than the FANG stocks? I'm glad you asked that, Paulette. Absolutely. As you start to learn this, especially with my weekly video training and all those bonuses that I give you here, that you can email in anytime you have a question on these, that basically we make sure you really understand it, and then you can convert it into any time frame on any stock. What you're going to find is that it will get the sweet spot of where the best part of the trend is. It will leave the chop alone. So if I could only trade one stock and there was nothing else that I could trade, then sure, I'd have to develop a lot of other strategies to trade that through every single type of market environment. I think that's a mistake to think that you can go from trend trader to trading range reversal trader and keep your mind straight. So I would rather say, look, focus on being really good at one pattern, whether it's with me and big trends or whether it's somewhere else, and don't confuse yourself with too much. There's lots of great speakers today. Soak them all in and basically then see which one resonates with you to decide, okay, hey, I want to go ahead and focus on this for a while and really see how I can make that work. It's really hard to try to assimilate. I see people try to do it where they take on multiple courses, multiple different providers, all of which may be quality providers, but then you try to assimilate too many things into one system and it doesn't work. You know, it's kind of, and technically we call it degrees of freedom. You put too many constraints on it, and all of a sudden it starts not performing. So we keep it really simple with this approach here. I think you find that really gives you your best results. Okay. Leo says, does it work on futures? It can. I mean, obviously, if you go to really short-term time frames, you're going to see more noise. And so when you see more noise, you're going to see that ADX line get whipped around some more. So my philosophy is I want to make sure I don't get into a lot of that noise. And so that's how we're going to do it. Now we started about 7 or 8 minutes late. We're 3 or 4 minutes past where I would usually cut off. So what I'm going to do, I'm going to try to help Jeanette get back on time by handing it back over to her. But bottom line is go to this page at bigtrends.com/FANG. You'll see that this BOGO offer, I call it my Christmas and July special or whatever holiday you like to celebrate at the end of the year, you know, now you're getting the equivalent of a holiday special here way before the end of the year, so you can lock in 2 years for the price of half of the price of one, actually, just $9.95. You get at least 200 trades from me over the next 2 years, and contact with me whenever you've got questions along with my Big Trends team. We do a great job, I think, of really making sure you're never left hanging, so that I don't claim I'm going to be right on every trade, but I can tell you that if it's not working, we'll tell you where to get out to. So you're never left wondering, what did they do about that one? Are they just burying that? No, we show you the good, the bad, and sometimes the ugly. And I'm really frank about it. I don't want you to just look at it like fantasy trades and somebody tells you I win all the time. I'm saying, no, you're going to have occasional losses, but we'll help you manage those. So trade management, it's easy to get in, it's harder to get out. Trade management is a secret in between, and that's what we do at Big Trends to really help you. And as BC says, options can be complicated. They can be. We keep it really simple. So I'm a big believer in the KISS principle. We're going to buy one option contract. When it's time to sell, we're going to tell you when to close it down. So check it out here. You can also reach us through our toll-free 800 Big Trends number if you have any questions, or you can email us through clientcare@bigtrends.com. I want to thank Jeanette for having me. It's always a lot of fun sharing you with lessons I've learned across nearly 3 decades of options trading. Back to you, Jeanette. Hope to see you soon next time you're here in Kentucky.
All right, Price. Wow, thanks for giving me a couple minutes back. I appreciate it because I got some stuff to cover over here. You just said 3 decades, so that was like, whoa. I think when I was writing emails about you a couple weeks ago for this event, I think I said 2 decades because I was like, well, I met Price in early 2000. I really don't know how many years. I was like, I'll just go safe, right? I'll say 2, but hell,
better to
3?
be safe.
Get it with the 3.
Yeah, thank you.
All right. I'm gonna take the power back and eject you. You can sign back in if you want, but it's safer for me to do it this way.
Take care.
Let me